This is where most retail traders lose money. They see this break of structure and enter, and this is exactly what institutions want. They enter here and put your stop loss below this other block, which is clearly a liquidity zone. When price trades down, it takes out the liquidity. Is another liquidity zone, and this is another liquidity zone. And these three liquidity zones will form a trend line liquidity. Once institutions see these liquidity zones, they push the price down, take out the stops, and once it gets to this top level, they will reverse the price and until it takes the swing high. This is not just a random liquidity video. It is going to expose a lot of things about liquidity. So make sure you watch from beginning to the end. And these are the things you are going to cover. What liquidity really means, how retail traders create liquidity, how institutions use the liquidity, types of liquidity, common locations where liquidity can form, and practical liquidity trading laws. Before we continue, give this video a thumbs up and subscribe to the channel. What is liquidity? Liquidity simply means areas where many stop losses and pending orders are sitting. Just like in these places we've pointed out, as you can see here, there is break of structure here, and break of structure traders entered trades and placed their stop loss below these lows without putting in context the strategy of liquidity. And when institutions realize that orders are pending here and stop losses are here, they pulled the price down and took out all the stops, then reversed the market. Institutions need these orders to fill their large positions. That's why they always hunt for liquidity. You may have been wondering how these liquidities are created, but let me tell you how retail traders create liquidity. Retail traders usually place their stop losses in a predictable location. For example, equal highs, just like in this place, equal highs, previous highs and low. Then trend line. This is trend line liquidity. Because retail traders place their stop losses on predictable locations like swing points, you have a market structure that is followed by institutional traders. Just like in this example, we have higher high, higher low. Big institution wanted to sell this market, and this is what they did. They bought till it got to the next swing high here. And when it got here, they started selling. As you can see, this candle here is institutional candle because it's only large institution that has the ability to move markets this fast. So they sold till it got to this support level. And when it got to this support level, remember that some retail traders have already started shorting the market and they put their stop losses above this high here. But institutional trader pushed it higher and took out all their stop losses because this is uptrend market. So they took out all their stop losses. After taking out the stop losses, they started selling again. They don't usually offload their orders once. They sell in tranches so that they will get the best price. That's why you see markets make impulsive move like this, impulsive move, then corrective move, then impulsive move. I want you to see liquidity as target and trap. Before we continue, let me show you the types of liquidity. We have two types of liquidity: buy side liquidity and sell side liquidity. Buy side liquidity, buy side liquidity is usually above highs, just like in this point. Then sell side liquidity is usually below lows. We can look at common locations where liquidity can form. We've already mentioned equal highs, just like here. After forming this liquidity, institutions pushed to take out the liquidity before this sell that happened. You can also find liquidity on previous day or week highs and lows, and there is liquidity in every swing point. You don't just mark out points from nowhere and call it liquidity. So you have to follow this video to the end, because the next session is going to show you the rules you will follow before marking out liquidity or before trading liquidity. Let's then move to practical liquidity trading rules. Before you can trade liquidity, you need to take note of these rules. Number one, wait for liquidity to be taken. You don't just predict where liquidity is or what will happen after liquidity. You wait for market reaction after liquidity has been taken. This is what I mean. Just like in this move now, in this impulsive move, we have areas where liquidity is formed, like here, 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 and several places, like all these swing points are marked. This is what happened. Markets made a correction and took out all these liquidities, all of them, till it got to this support level, which is another block. It got to this support level. When it got to this support level, market reversed and took out the other liquidity that formed here, the sell side, buy side liquidity. Buy side, these ones are sell side liquidity, which form this trend line. So you can see after taking out all this liquidity, markets reversed and continued the uptrend. So you don't just mark any place and call it liquidity. This one is following market structure. And that leads us to the next rule. Confirm with market structure shift. You don't just mark points from nowhere. We are following market structure, like higher high, higher low, higher high, higher low, just like that. Then you look for strong displacement. When market has taken out all the necessary liquidity, there will be reasonable displacement and confirmation before you enter a trade. Let's pick one part of this market and do example. Like in this move, here is an impulsive move and we want to trade the continuation. We have, after break of structure, here is a break of structure of the other move. We have liquidity being created along this impulsive move, and there is correction. After market took out liquidity, there is a support level here, and this support level has other block. When it got to this other block, you can see that market pushed back aggressively and there is displacement. So once we confirm this, we can then enter market here and target the next swing high the next swing high, which is here, which is here. So we pick out our buy to place here. Once we confirm that market is reversing, and put our stop loss slightly below the other block here and target the next swing high, which is, as you can see, price traded and our take profit was hit. So this is how to trade liquidity. Liquidity is fuel for institutions. Don't trade the breakout of liquidity. Trade the reaction after liquidity is taken. Always wait for displacement and structure. See you in the next video.